Hello guys, you're welcome. This is Mr. Wealth. All right, welcome to my YouTube channel, and I promise that this will be a very interesting video. So I want you to relax, get a pen and your paper to put down whatever you feel you need. Okay, now let me ask you this question. Have you been in a situation, right, where first day you traded, you made money, second day you traded, you made money, third day you made money, fourth day you made money, fifth day you made money, sixth day you traded and you lost all the money you made? Has it ever happened to you? This happens to a lot. I mean, over 70% of futures traders, okay? Over 70% of them, this happened to them. Not once, not twice. I have been there in the past. Okay, so you need to understand that when you are trading futures, you must get some things right. It is a must. There's a difference between a trader and a profitable trader. You can say, oh yes, I am a futures trader. It doesn't matter how good you are with technical analysis or fundamental sentiment analysis. It doesn't matter how good you are. One mistake can cost you your portfolio. Okay? So there are a lot of things you need to put in place to checkmate this so that this doesn't keep happening again and over again. All right? Okay? So you need to understand that when you are trading futures, there are two things that are of most importance. The first thing is your money management skill. Your money management skill. You must know, you must learn, you must be very conscious of how you manage your money, how you manage your equity. You must. The next thing is you must understand and know the trade size, your trade size. And it is from your money management skill, let me call it a skill, that will determine your trade size. For example, sometimes we break this rule, and it affects us. People break it and it affects them. It affects them. Now, let's say you have $500 as your equity, and you are consistently entering a trade with $50. Okay, $50. And as you are winning, and you kept on winning, as you are winning, your confidence is being boosted. Right? You'll be proud of your achievement, right? Now, because of the fact that your confidence is being boosted, you will now say, perhaps it's as if all my trades are going well. Now I'm going to enter a trade with $1,000 with everything I have because I know I'm always winning. And that mistake would now cost you everything. I'm very sure people can relate with this particular scenario. So you must understand that you must manage your money. You must manage your money. Trading without good money management is like pouring petrol on your money and lighting the matches. Honestly. So you must understand how to manage your money. You must understand how to use your trade size. Okay? Never, ever use all your equity to enter one trade. As they say, don't put your eggs in one basket. If you use all your equity to enter one trade, it means you are putting all your eggs in one basket. And it is very dangerous. It can be very disastrous. It's possible you can win, but hey, don't tempt that. Okay? Managing your risk and sticking to your trade size. So the second thing is, don't, or rather, use 10% maximum to enter of your equity, maximum to enter a given trade. For example, you have $1,000, okay? You have $1,000, and maybe you got a trade signal, or you did your technical analysis, and you say, well, this trade will go, maybe it will go long or go short. Doesn't matter how confident you are, just use 10% at most. Okay, at most, maximum 10%. In this case, if you have $1,000, 10% of $1,000 is $100. Use it to enter your trade. Build your capital, build your equity. It's a process, okay? It is not just a destination, okay? You can even be more conservative. And say, no, I'm not going to enter any trade with 10%. I'm going to enter with 7%. I'm going to enter with 5%. Now, in the case of, let's say you have $1,000 and you enter a trade with $100 and you risked, let's say, maybe let me say you even risked 20% of $100, which is $20, right? And the trade went against you. You lost $20. You will still have $980, right? Good. Let's say you enter another trade. Don't forget you have $980 left. You enter another trade with, let's say, still $100. And it hit your stop loss again, you lose. And in this case again, let's say you lose $20 again. It means your balance will be $960. Okay? Let's say you enter a third trade again with $100, and in this case, luckily, you win maybe 40%. 40% of $100 is $40. You've covered up your initial loss, right? You enter another trade again, you make profit. 20% of $100, which is $20. It means now you have $1,020, right? You enter another one, you make profit of 30% of $100, okay? That is $30. You have $1,050. You enter another one, you lose it. You lose, maybe it hit us, take your stop loss, and you lose $20. It means you now have $1,030. You enter another one, you win. You get it? So once your take profit is there, once your stop loss is there, it will help you to mitigate against excessive loss, against emotional loss. What I mean by emotional loss is sometimes when you are trading without, maybe let's say stop loss, and the trade is going against you, you say, oh, maybe you entered with $100 and you have lost $20. You say, no, how can I lose $20? I will still be in this trade. Let me see if it will recover. Before you know, you are losing $30. You are losing $40. You are losing $50. You say, wow, no, I'm not going to exit this trade. I will still wait. Let me see if it will recover. Before you know, you are still losing. That is emotional loss. Before you know, you are out. Okay? So you need to understand this. Don't use almost all your capital, at most 10%. Trade wisely. Okay? Now, the third one is the leverage to use. Now, this depends on the risk you are willing to take. This depends on the risk you are willing to take. 5% leverage, 10% leverage, they are okay, they are normal. Some persons who are using high equity, all right, to trade, they will use 3%, 2%, 4% leverage. If you are using, let's assume you are using $100,000 to enter a trade, and you used 3% and 3x leverage, and you made that 3x leverage gave you just 5% profit. 5% profit of $100,000 is $5,000. So you get it. So that is why those who have high equity, they tend to use smaller or lower leverage. Okay? Okay? So don't over leverage. Don't over leverage, especially if you're a beginner. Don't over leverage. All right? If you want to use high leverage, 30, 50, 75, 100, 125, all right? Ensure that you are entering with a very low equity. A very low equity. If you have $1,000 and you are using 100 X to trade, you can even use as low as $20 to enter that trade. Yes. Yes. Okay. As low as $20 to enter that trade. Okay. Hope we are following. Right? So you need to understand that trading futures is extremely risky and extremely profitable. It can to you like a dream. You wake up, wow, look at awesome profit. Wow, liquidation. That is why we call it P&L. Okay? Okay? So don't always forget to use stop loss. Don't ever forget to use that. Don't ever forget to use that. You must use stop loss. And I think the fourth one, don't gamble. You are not a gambler. If you call yourself a trader, then don't gamble. A gambler is someone who wants to double his or her money within 1 minute, within 1 hour, within 24 hours. No, no. That can happen, of course, but it can also come with high price. Okay? It can come with high price. So trade as a professional, not as a gambler. Okay? Trade as a professional, not as a gambler. A professional trader manages his or her risk very well and have a target of profit. Like one of my personal project, which is $1 million in 60 days, all right, 70 days, using compound interest, okay, compound trading. What I do is 10% daily. I'm out. Because I know it's easier for me to, I can even do 5% daily. So you must have a target in mind. If you have a target in mind and let's say every day is okay, my target is to make $5, okay? You made your $5, you can go and rest for that day, wait for the next day. If you say, oh, my target is to make $5 and you made $10, if you want to still trade again that same day, trade with the excess. And in this case, the target is to make $5, you make $10. The excess is $5. So, and you want to trade again, trade with just that $5, the excess. If you make profit, good. Okay? Don't hit your target and still risk your target. It's not a good one. It's not a good one. Okay? It is better you make 5%, 6%, 7%, 10% consistently every day than to chase 50% or chase 100%, 200% and lose everything. Yes, of course, sometimes we do 100, 200, 300%, right? We do that, of course. But not without protecting the amount you have made. For example, I enter a trade, the trade is giving me 20%. I can decide to lock my profit in 15%. If the trade goes up again to 30%, I'll lock my profit in 25%. So as the trade is going up, I'm locking it, or I trail it. All right? Okay? So it is better to make that 5%, 10% consistently than to lose everything because you are chasing the huge percent. Okay? And if you are in any trade, let's say either free or premium paid signal channel, you need to know that you are also responsible for your loss and your profits, not the signal provider. Now let me tell you what to do. Let's assume in my signal group, okay, I say okay, long Bitcoin at, let's say the current price is 1,000. Oh, sorry, let's say the current price is $20,000, and I say long Bitcoin, first take profit is $20,500. Okay, what do? You can decide to say, okay, if the signal provider is giving his or her own take profit to be $20,500, me personally, my own take profit to be $20,400. You get it? You get it, right? So your own take profit can be a bit lesser or closer to the take profit of maybe a supposed professional who is offering signals. Hope this is clear. With this, you can even make more money. And let me tell you why. Sometimes I can say, okay, long Bitcoin at $20,000, take profit, first TP, $20,500. Bitcoin can go up, can go and get to $20,480 and fall back. Not just Bitcoin, any other cryptocurrency. Okay, it can fall down back. And in this case, it didn't hit my take profit. But because you set your own take profit a little closer or lower to my own, it will hit your own take profit. And you make your money. Because sometimes I've discovered that sometimes when a trade goes close to a take profit and it doesn't hit that take profit and it reverses, sometimes it will reverse to the downward. But if your own TP is is close to the take profit of the signal provider or the supposed professional, and his own didn't get hit, your own will get hit. You get it? That is awesome. That is why I always tell people, aim at the moon. If you are not able to touch it, you fall among the stars. So if you're not able to touch or the trade is not able to touch the take profit of the signal provider, it will possibly touch your own, okay, which is below that of the person, okay. So and again, when you are trading, let's say you enter a trade, I say long Bitcoin at $20,000, take profit $20,500. Once the trade is going in your favor and hits the first take profits, maybe let's say there are multiple take profits. Once the trade hits your first take profit, what do? Move your stop loss to your entry. Move your stop loss to your entry. As the trade keeps going higher, right? As it keeps going higher, you can move your stop loss to the first take profit. In this case, you are securing, you are safeguarding, you are protecting the profit you have made. You have made. Why? Futures trading is volatile. It is filled with a lot of manipulations. A whale can just come and manipulate the market within 5 minutes, within 2 minutes, within 3 minutes. A whale can just come and just enter a trade with $1 million. All they want is just maybe 5% of that. 5% of $1 million is how much? That is $50,000. So we can decide to just throw in $1 million, get 5%, pull it out. Once the person pulls out $1 million, or in this case, $1 million plus the profit, what do you think will happen? It will affect the market. It will affect it. That's why you need to